Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over gifting non-cash property to minimize future estate tax. And we're going to be doing that the SuperfastCPA CPA way, which is diving straight into questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and again, it's 1 hour, it's free, and it will save you so much time struggling with your process. Make sure you go check that out. The link will be in the description. Also, we will only be going over 5 questions in this video, but Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it and more practice by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Alright, here is question 1. Mrs. Clark is contemplating gifting a rental property to her daughter Jessica to minimize future estate taxes and capitalize on Jessica's lower capital gains tax bracket. The property was purchased 20 years ago for $200,000 and is currently valued at $800,000. Mrs. Clark's estate is valued at $11 million, nearing the federal estate tax exemption limit of $12,060,000. If the property appreciates to $1,200,000 over the next decade, and Mrs. Clark decides to gift the property now, what is the immediate impact on her lifetime exemption, and how does it affect her estate value? Assume the annual exclusion is $15,000. Okay, so there's a ton going on here, and if you don't really know anything about estates or gifting with estates and different things like that, that's okay. We're going to dive straight into the answer for this one to start getting an understanding. Okay, and the answer is that the lifetime exemption would be reduced by $785,000, whatever that is. We're going to learn about that in a second here. And her estate value immediately decreases by $800,000, effectively managing estate size and potential future estate taxes. Okay, so let's read about this. First off, there's a lifetime exemption. When Mrs. Clark gifts the property valued at $800,000, she can use her $15,000 annual exclusion for each person. And again, we talked about that in the previous gift video, leaving $785,000 of the gift's value to count against her lifetime exemption. This use of the lifetime exemption reduces it from the federal limit of $12,060,000 by $785,000. So overall, there is a lifetime exemption for gifting things. Each year there's an annual exclusion, which is how much can be taken out of each gift and not be taxed. But there's a total lifetime exemption of giving gifts that each person has. So each gift you give reduces your exemption by that amount. And then once you get over that amount, there's other tax consequences. And then as far as the estate value, by gifting the property now, Mrs. Clark immediately reduces the value of her estate by the full current market value of the property, which is $800,000. This is strategically advantageous as it does not only decrease her taxable estate, but also removes any future appreciation of the property from her estate, thus potentially saving significant estate taxes in the future if the property's value increases as expected. So as you'll see in this video, the theme of this video is planning and thinking about the consequences of gifting or not gifting certain property when it comes to trying to minimize estate taxes. So you'll see in this video us talking about minimizing the amount of estate there is to be taxed. We'll talk about different fees that can be avoided. We'll talk about the consequences of the person selling something so that it's not in their estate versus just gifting it so that it's not in their estate. We'll learn about all those different things in this video. So let's go ahead and go to the next question to learn some more strategies for minimizing estate tax. Okay, here is question 2. Eleanor is considering gifting her niece, Clara, stock that has significantly appreciated since its purchase. Eleanor's current income tax bracket is 37%, while Clara's is 22%. The stock was originally purchased for $50,000 and is now worth $150,000. Assuming the capital gains tax rate corresponds to their income tax brackets, calculate the potential tax savings if Eleanor gifts the stock to Clara and Clara sells it immediately compared to if Eleanor sold the stock herself. So right now, Eleanor's trying to decide, should I just sell the stock or should I gift it to Clara, which is more beneficial for me in my estate? So go ahead, think through this. You can probably figure it out if you read through carefully. So pause the video, do the calculation, and when you're ready, come back. We'll look at the answer together. Okay, and the answer is that if Eleanor sells the stock herself, she's going to incur $37,000 in capital gains taxes, while Clara would only incur $22,000. So Eleanor saves a lot of money in capital gains tax by giving it to Clara, essentially $15,000. So let's read about it. If she sells the stock, her capital gain is $100,000, and that's taxed at her 37% tax rate. So that's $37,000 of capital gains. Whereas if Clara sells it, again, same capital gain, because when you gift property, it's gifted at the owner's original cost basis. That means that her $100,000 gain would be the 22% tax rate, meaning that she only pays $22,000. So as far as for Eleanor, she's saving money by gifting it rather than selling it herself and ending up paying those capital gains taxes herself. And it's better for Clara because she gets that capital gain, of course, and she's paying less taxes on it than if Eleanor had sold it. This is another way to think about estate tax planning, whether you should sell something so that you don't have to deal with the estate taxes later when you pass away, or should you gift it to somebody and they end up paying those taxes, and also they're going to probably pay less taxes if they're in a lower tax bracket than you. So just some things to think about. Let's go ahead and go to the next question. Okay, here is question 3. Jane purchased an investment property 10 years ago for $300,000. The property is now worth $800,000. She is considering gifting it to her son, Tom. Assuming the capital gains tax rate is 20% and that the estate tax exemption is fully utilized, calculate the potential capital gains tax if Tom sells the property immediately after receiving it as a gift versus if he inherits the property at Jane's death and sells it immediately. What is the difference in tax liability under these two scenarios? So this is a little bit of a different look at it. This is Jane trying to think about what is the best case for Tom. She's trying to plan her estate, whether she should give it to him now or have him receive it when she passes away, and what the consequences will be for Tom in those two circumstances. So pause the video, think through this, do the calculation, and when you're ready, come back. We'll look at the answer together. Okay, here is the answer. Answer A. If gifted now, Tom pays $100,000 in capital gains tax, but if he inherits it, he potentially pays $0, and let's walk through that. So if it's gifted now, he inherits her cost basis of $300,000. That's how gifts work. He sells the property immediately because it's worth $800,000, so he gets a $500,000 capital gain, which is then taxed at the 20% tax rate, giving you $100,000 of capital gains tax. But if he inherits it later when she passes away, property is usually stepped up in its fair market value at the time of death. So let's assume it's still $800,000 for simplicity by the time she passes away. That means that Tom's basis in it when he receives it is, instead of $300,000, it's the fair market value of $800,000. So if he sells it right away, he doesn't have a capital gain, and so since there's no capital gain, there's no tax to compute on that. So that leaves $0. So there is a big difference there between whether he inherits it or whether she gifts it to him now. Now, obviously, things could change over time. Maybe it wouldn't actually be $800,000 by the time he receives it. But again, typically there is that step up in basis when you inherit something. So that can be something to consider when you're trying to consider how much tax somebody's going to pay when they receive it and then sell it and things like that. All right, let's go ahead and go to the next question. Okay, here is question 4. Mr. Thompson is planning to avoid probate fees by assigning his $500,000 brokerage account directly to his beneficiary Tom via a transfer on death or TOD designation. Assuming the typical probate fees are 5% of the asset's value, how much would Mr. Thompson's estate save in probate fees by assigning the account directly through a TOD designation? Now, this question is very easy as far as the calculation. So go ahead, pause the video, do the calculation, and when you're ready, come back. There's a lot more to this question that we need to learn besides the calculation. So when you're ready, come back, we'll look at it together. Okay, the answer is $25,000. So they save $25,000 in probate fees. Let's learn all about this. I'm actually going to read this second paragraph first just to give a little bit of context. Probate is the legal process through which a deceased person's will is validated. Their debts are settled and their assets distributed according to the will or state law if there is no will. It involves court oversight and can be time-consuming and costly depending on the complexity of the estate and the laws of the state. Non-probate assets are those that bypass the probate process and transfer directly to a designated beneficiary upon the owner's death. These include assets held in joint tenancy, retirement accounts with named beneficiaries, life insurance policies, and assets held in a trust, among others. So basically, probate, all the fees that come with figuring out who gets certain assets and whatnot. But there are non-probate assets that can be assigned to avoid probate fees. And that's what happened here. Mr. Thompson assigned directly this brokerage account to Tom or basically had a designated beneficiary, and that helped them avoid probate fees. So now let's read the tax implications with that understanding. While a TOD designation effectively avoids probate fees, again, that's what happened here, it does not exempt the asset from potential estate taxes or capital gains taxes. The asset's value at the time of Mr. Thompson's death will still be included in the estate for tax purposes, assuming the estate exceeds the federal exemption threshold. Additionally, Tom will inherit Mr. Thompson's cost basis in the account, though it will most likely be stepped up in basis. Again, remember we were talking about that before. A lot of times when items are inherited, they are stepped up in basis to the fair market value. If Tom sells the assets, he will be liable for capital gains tax on any appreciation since the original purchase or the step up in basis if it occurred. And again, that usually does occur, but maybe there might be some situations where it doesn't. But that is something to consider. If Tom sells the assets later on after he inherits it, he may end up paying capital gains tax if the asset has continued to increase in value from the time that he inherited it. So this is one thing to think about. If you designate a specific beneficiary for an asset to be received later, you do save money on probate fees. Probate fees aren't necessarily taxes per se. The item will still be taxed from the estate and different things like that, but it is money that doesn't have to be paid if it's specifically designated to a beneficiary. Okay, we're learning a lot about estate tax planning essentially in this, so let's go ahead and go to the next question. Okay, here is question 5. Mr. Williams wishes to gift $3 million to his granddaughter, bypassing his daughter in the inheritance line. Assuming the GSTT exemption has been fully utilized by previous gifts and the GSTT rate is 40%, calculate the GSTT due on this transfer. Again, this is another one that the calculation isn't too difficult, but there's a lot to learn in the explanation. So go ahead, pause the video, do the calculation, and when you're ready, come back, we'll look at the answer together. Okay, and the answer was $1,200,000. Again, not too difficult of a calculation, but let's learn what GSTT even is. GSTT, or Generation Skipping Transfer Tax, is imposed on transfers to a skip person, or basically a generation 2 or more levels below the donor, that exceeds the GSTT exemption limit. Since Mr. Williams has already used up his GSTT exemption on previous transfers, the entire $3 million gift is subject to the GSTT at a rate of 40%. Therefore, the GSTT would be 40% of the $3 million, which equals $1,200,000. So this is another thing to consider when you're planning your estate and trying to get rid of things potentially so that you don't have to pay as much estate tax. And so you might be gifting things to a whole bunch of people. Maybe you're gifting something to a granddaughter or a grandson, or even a great-granddaughter or a great-grandson, and that would be considered generation skipping. And there is a tax for that if you've already gone over your exemption limit for generation skipping gifts. So again, this is something to consider. Let's look at it a little bit more. The Generation Skipping Transfer Tax is a federal tax designed to prevent the avoidance of estate and gift taxes through transfers of wealth that skip a generation. Under the GSTT, both direct transfers, like a grandparent leaving an inheritance to a grandchild, and indirect transfers through vehicles such as trusts, where the ultimate beneficiaries are more than one generation younger than the donor, can be taxed. The GSTT applies if the transfer exceeds the GSTT exemption amount, which, for example, in 2024 is $12,920,000 for an individual. Don't pay too much attention to that because, that changes year to year, but that's just an example. This exemption is separate from the regular gift and estate tax exemption. The tax rate for GSTT is equal to the highest federal estate tax rate, 40% in this example. It's crucial to note that any amount used from one's GSTT exemption does not reduce their available estate tax exemption. These are separate exemptions. So again, one more thing to consider. If you're trying to give stuff away, gift it so that your estate is smaller and you're trying to minimize your estate for estate tax purposes, but you're giving it away to a whole bunch of different people, and then you go over your GSTT exemption by giving something to one of your grandchildren or something like that, then there will be tax consequences for that as well. So it's something that you have to balance and think about. All right, with 5 questions, we've learned a ton about the implications of gifting property for estate tax planning and things like that. So before we go any further, let's go ahead and do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice things that keep popping up. These are the things or the concepts or the calculations that you've seen in 4 or 5 questions throughout your studying, and you know that they are important because, again, you've done them over and over again. So you write them down as a pillar topic so that you can remember it and study it later on. Let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. First off, gifting assets during the donor's lifetime can reduce the size of the estate and potentially decrease future estate tax liabilities, especially if the assets are expected to appreciate further. So again, all of this is about trying to minimize estate size and tax. Then there's the generation skipping transfer tax, and this is applied to transfers to non-immediate generations, such as grandchildren, with the tax rate equating to the highest federal estate tax rate. This tax is imposed when transfers exceed the GSTT exemption, which is separate from the regular gift and estate tax exemptions. Then there's probate and non-probate, another thing to think about. Probate is the legal process to settle an estate, which can be avoided with non-probate assets like those transferred via TOD or transfer on death, or POD, payable on death, designations. Non-probate assets transfer directly to a designated beneficiary and do not form part of the probate estate, thus avoiding probate fees and delays. Again, it's still part of the estate, it's just not part of the probate process, so the estate is avoiding those probate fees. And I'll talk about that again right here. While TOD and POD designations can bypass probate and simplify the transfer of assets, they do not shield the transferred assets from estate taxes. So that's still something to think about. Capital gains tax on gifts versus inheritance. When gifting an asset that has been appreciated in value, the recipient inherits the donor's cost basis and is liable for the capital gains tax if they sell the asset. In contrast, assets inherited at the donor's death usually receive a stepped-up basis to the fair market value at the time of the donor's death, potentially reducing or eliminating capital gains tax. So again, all of these things are things to consider when it comes to somebody's estate when they pass away, or when they're planning their estate for when they pass away. You know, some of it has to do with what's going to happen to the people I give these things to. How am I going to avoid fees? How am I going to avoid all this tax? Can I give things away to people, but there might be extra tax because of the GSTT? There's just a lot to juggle with this. So those were the pillar topics from this video. A lot to think about there. And with that, that is the end of the video. Again, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam. And again, only 1 hour. It's free, and we will save you so much time struggling with your process. Also, if you liked this video and liked going through these 5 questions, just remember that Superfast CPA members will have access to the full 10-question video when we post it on the members forum, so you can get more practice and more help if you become a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.